consult your financial advisor prior to making any trading decisions. All right, so before we jump into trading system, let's talk about current market conditions. So I'm pulling S&P mini chart. I'm doing 1 month since the FOMC meeting and the tariff escalation that happened here on first week of August. So market sold off from 3,000 to 2,950, and since August 1st, 2,950 has been overhead resistance. So we can clearly see, let me see. So you can clearly see that 2,950 has been overhead resistance. We reached it today, again, on the de-escalation of the tariff news. So basically in the past, it's interest rates and tariffs. When there's positive news, market reaches 2,950. When it's negative news, market reaches 2,810. Sometimes it overshoots to 2,775. We had that when China lowered its currency. But for the most part, it trades in between 2,815 and 2,950. So again, we are approaching decision whether the tariffs will be imposed over the weekend. At least on additional 150 billion of dollars will be potentially taxed at 10, I think 15%. So if that happens, then most likely the market will sell off and retrace at least to 2,800 level or 2,771. These would be major support level. I would say bulls have to hold on to 2,810 level. That's the first level of support. If bulls are unable to hold on to 2,810, then I think market will quickly drop to 2,773 or 2,730, which was the May low. If we have a positive news where tariffs are being delayed, or maybe there's some kind of an agreement where China is actually buying agricultural products or increasing their purchase of US products, then potentially market will break the 2,950 level. It also corresponds to the 50-day moving average and will retest all-time high around 313, 3,000. So those are the two scenarios. You have to be prepared for both. On the upside, there's not a lot of room to the upside, right? Potentially 1%, maybe 2% to the upside. So I think the upside is limited. The downside could be at least 150 points. So you have 50 points to the upside, 150 points to the downside, maybe even 200 points to the downside, and that could be let's see, 150 points. That's about 5%. So you have 1 or 2% to the upside and potentially 5, maybe even 10% to the downside. So in terms of risk versus the reward, I personally right now build more bearish positions, so hedges. I'm buying VIX calls, buying VXX in the live trading room. You see I have a SPY put spread, 300, 2,900, and 300 to 295 put spread, because I don't think the 300 level will be broken. And I'm buying VIX call spreads, and I'm trimming my bullish position. Ultimately, going back to trading psychology, we just recorded a webinar. So if you're not registered with Yellow Tunnel, I encourage you to register with Yellow Tunnel. And under quick navigation, mental strategies. We just recorded this week, Your Brain and Uncertainty. I think this is a very important webinar. And if you haven't viewed this webinar, I think this would be a good homework. I know it's a Labor Day weekend and everybody wants to spend time with the family, and you should do that first. If you do have any time left up until Tuesday, then I would encourage you to watch this webinar, maybe even today before market close. It basically shows Dr. Maneker is he's a clinical psychologist who's been mentoring a lot of traders, professional traders, institutional traders for many years, I think over 20 years. And he's also a professional trader. So it's a very rare combination for someone to be clinical psychologist, one-on-one coach, but also a trader who does this more or less full time. So I think this is a great perspective on uncertainty. And some of the key points that Dr. Maneker mentioned is that the more uncertainty it is in the market, the more likely we rely on the biases, right? Hindsight bias, confirmation bias at yellow tunnel. Under weekly market plan, I talk about different topics on trading psychology, but also go over current market conditions. So I encourage you to review weekly market plan also. And the idea is that as uncertainty is elevated, we rely on our biases, on, whether it's a hindsight bias or confirmation bias. And the more uncertainty, we have uncertainty about tariffs. We're not really sure what's going to happen with interest rates when FOMC meets the second and third week of September. Earnings season is going to start middle of April or middle of October. We have Brexit due by end of October. So next 30 days, there will be a lot of uncertainty. So it's very important to be self-aware and recognize that market has a lot of uncertainty. And when we face with uncertainty, we don't rely on objective data. We rely more on the emotions and our biases. So first step is important to understand this, important to look at the data and concentrate on things that you have control over and not spending too much time on things that you don't have a control over. Ultimately, nobody knows what will be the outcome of the weekend. So you have to prepare for both case scenarios, right? You have to close your eyes and imagine it's Tuesday, right? After Labor Day weekend, everybody spent time with family, barbecued. On Sunday night, there will be an announcement. And there's two outcomes. Market is going to jump to 3,000 level, right? It'll jump 50 points to the upside, maybe even more, maybe 70 points, but likely scenario that it's going to move 1.5%. That's one scenario. The other scenario, market is rapidly going to sell off to the 2,800 level. You should be prepared for both scenarios and not be very critical of yourself that you did something wrong. Right now, you have an opportunity to rebalance your portfolio. You can close your eyes and imagine it's Tuesday and market is at 3,000. What does your portfolio look like? If all your position go up by 1 or 2%, if all your hedges will go down by 1 or 2%, what will your portfolio look like? Is this part of your trading plan? And are you comfortable with your portfolio drawdown? And again, comfortable might not be the right word because if you have hedges, those hedges will go against you. Nobody likes to have losing trades, but overall, is this something that you consider part of your trading plan? And part of your trading plan, you should know what your stop losses are and what your target gains are for individual position across all your position. So that's one scenario. Try to make it as vivid as possible. Listen to the CNBC news, Bloomberg, how everybody's trying to rationalize why we reached 3,000 level. That the economy is great, low unemployment, consumers are strong. Target, Walmart, Dollar General announced great earnings, so U.S. consumer is still buying. And you hear all these news trying to rationalize why we're at 3,000 level, and you review your portfolio. But instead of doing this on Tuesday, you do this. What is it called? Not post-mortem, but pre-mortem, right? So you do this pre-mortem analysis, not sure what the right word is, but you do this time traveling exercise and you do it right now. Because right now you have an opportunity to make sure that your portfolio is well rebalanced. Now, try to make it as vivid as possible. See how you're writing down journals, see how you're grading yourself in terms of whether the trade was successful or non-successful, and try to be as vivid as possible. And the research shows that when you prepared for an outcome, you consider an outcome, and there's a high probability of success, right? It could be, 30%, 40% probability that, we're going to reach 3,000 level next week. So that's one scenario. You document it, you prepare it, and you go over it. The second scenario, tariffs are being imposed, right? So $150 billion gets taxed at 15%, and the rest of the tariffs get increased. The original 150 billion tranche gets increased from 10% to 15%, right? Market is probably not going to take it well, and it will sell off to first level of support will probably be 2,800. So then again, close your eyes, imagine it's Tuesday, and imagine how, you turn on Bloomberg, you read Wall Street Journal, and you make it as vivid possible in terms of these stories, right? The story will say, it's very important to protect our intellectual property. It's very important to make sure that we are fairly treated by China, and it's very important to to move the businesses outside of China, reduce the dependency on China, and move them to other Asian or North American or South American countries, being diversified, not dependent on China, and we don't really need China to be our partner. So listen to this news, imagine reading these news, and look through your portfolio. What happened to your long position if the market sells off 5%? Imagine your stop trigger levels being triggered on your bullish position. If you build bullish position, and imagine that what happened to your hedges, how they went in your direction, and what was their percentage portfolio, and what your portfolio looks like. So when the market does reach those two levels, extremes, then you're prepared for the outcomes. And the third outcome is that it's the same news, right? Maybe a little positive, maybe a little negative, and we're still trading between 29.50 and 28.17. Maybe we're at 2900, maybe 28.75. So in terms of statistics, I think one standard deviation, there's 70% chance we're going to trade between 29.50 and 28.11, somewhere in this range, depending on the news and interpretation of the news and the response from China, right? We rally because China said, they will not immediately retaliate, but that could be Tuesday, then on Wednesday they will retaliate, right? Nobody knows what immediately means. And so one standard deviation that will trade in the range, continue, nothing new is going to happen, and whatever happened in the past 30 days will happen in the next 30 days. And then the other two scenarios is that we reach in 3,000 and 2,800.